Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsAndMarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are. We get our Friday together with our listeners.
And we have at least 3 listener questions today. Our first one comes from Kathleen, who always will have some kind of a musical mention in her question. And yes, there we go. I just opened it up. Kathleen's comment: Jim, last week was a great lineup of podcasts as usual, Bob. It was very interesting to hear on last week's podcast that the first Operation Twist was in 1963 and that the name was inspired by Chubby Checker's dance song in 1960 called The Twist. Well, Chubby also released Limbo Rock in 1963. Of course, the whole goal of the limbo is to see how far you can lean backwards without falling over. And I remember my parents' parties from around then and drunk people falling flat on their backs and on their heads and laughing and trying to do it again. Anyway, she asks, all these margin clerks right now seem to have very little experience, and with people asking how low can things go, how much lower can this limbo stick go before the margin clerks stop the dance? It seems to me that a lot of the people who are talking about the market say, unconvincingly, at least to her, that there's plenty of upside into 2024. Bob, how low can you go?
Yeah, the limbo dance was fun, but it wasn't one of my great skills. Anyways, good allegories here on the music side, Kathleen. The market is highly speculative, as we've been saying. Not just highly speculative, but measurably speculative. And that's on the technical sense. So what you do is you've got standard kind of measures like I often use the momentum, the weekly RSI. And so on stocks, and like recently the bank stocks have been flying, and base metals, copper, crude oil's getting up there, lumber went crazy. So these speculative bursts are very intense and are measurably high. You can often have a high for copper around March and then another one in July, so we've got some overbought. So what the main thing I'm trying to point out here is that the speculation in any of the hot games has become extremely hot. And for this year, we're boldly saying that this year could set the peak. Back in October, we looked for a rally out to January and noted it also could include a huge speculative phenomenon, which did occur. You got great action in the GameStop thing and then Bitcoin again. So you're having this. And but as to the limbo, when you're trying to do something that's impossible. In the case of the limbo dance, it was to get under a bar that was far too low. Somebody's going to fall on their Pratt at some point. But Kathleen, great imagery.
Question from Michael. Hi, Jim and Bob. My question's for Bob. It seems that the gold miners have broken the neckline of a head and shoulders pattern that suggests a decline to 1,500 may be possible in the intermediate term for the price of gold. The dollar is gaining strength and the equity market seem to be topping. Bob, how might this all play out over the intermediate term?
Yeah, you're looking at it the right way, Michael. The gold is quite an extensive move down, and obviously now opposite to the speculation going on in the stock market. So when we're going to go back to last summer, when in July we were getting all kinds of upside exhaustions and sequential sells and everything on the gold sector, and advised that investors and traders should take some money off the table, we noted the excess, but you couldn't really have a reason for the decline in the sector other than it got too much. But it's now easy and not easy, but it helps to look over your shoulder and say, yeah, all of the hot action's going into stocks and low-grade bonds and not into gold. So that's just the way it is. So this suggests that perhaps when the high speculation does roll over, that then the careful money will go to the most liquid items, and gold is a very liquid item. Also, shorter than 1 year treasuries in the New York money market in U.S. dollars is very liquid. So you could have a case where the frightened money, no, let's not lose that one. Let's say careful money is going to the liquidity of gold and the liquidity of treasury bills, in which case you might have a bid for gold at the same time as you have a bid for the U.S. dollar. There have been times in the past when gold has rallied, when the U.S. dollar was steady or even rising a little. Could be one of those. But we're watching, because we really like the gold sector and it's in a major bull market, watching for the next entry point to buy some gold stocks.
Michael's second question. As a contrarian, I'm prepared for the bottom to fall out from under the markets, taking all boats down with it. My intermediate dumbbell strategy is to continue to hold gold bullion at one end, and at the other to hold U.S. dollars, 10-year treasuries, and a short on the GDX. No equities, and the U.S. dollar will be treated as king. When gold bottoms with the first leg down in the equity markets, I then would sell the treasuries and go long with the gold miners and maybe energy stocks. Bob, does this strategy make sense?
Well, being long 10 years has been a very uncomfortable trade for the last while. From the 10-year out to the 30-year has been hit in price very, very hard. But just in looking at the bond future, Michael, it's coming down to test the low set a couple of weeks ago, and the long end of the treasury market is technically very oversold. And of course the reason being is that all the hot money is playing the hot games, and then you've also got the inflation story has come in, that with the new socialist administration, that the both Fed and Treasury be even more reckless than previously. The Fed has been as reckless as you can get, and to make it even more reckless would be impossible. So that's all in the market. We're not looking for this to turn into runaway inflation, and indeed seen some headlines recently about this is all going to do runaway inflation. But at any rate, the longer dated treasuries are just now becoming a buy. But for the very careful money, and I've mentioned this before, you can, if you go to T-bills, you're going to get zero. But if you're in longer dated corporations, rates can go up and you'll get hit at the long end. So the 3 to 4 year treasuries, or sorry, 3 to 4 year good grade corporates will be okay. It may not get downgraded. You've got a 4-year maturity, so you're going to get par at that stage, and with a good grade one, they're not going to default on you. Whereas if you just go for cash, you're going to get 0. So, anyways, Michael, thanks for the question.
Bob, one thing I want to say, at least it seems that Michael has a plan. Many people have no plan. What if the stock markets collapse? What is your plan to get through that? Is it important to have a strategy?
Oh, yeah. Yeah, this is, you got to be methodical. Sit down and face it out. But, yeah, and as I said, that this is now a good time to be considering buying a longer dated treasury, and also a good time to be buying a 3 to 4 year corporate bond to really be, that's your dumbbell kind of position. So, yeah, you always want to be questioning, looking, and making a plan, a strategy.
Andrew writes to us and says, a small but growing number of professional sports athletes have started receiving their salaries in Bitcoin. As a group, historically, they have not proven to make good investment decisions. Will this time be any different?
Yeah, Andrew, thanks a lot for that one. Yeah, I would say that many professional athletes are probably not sophisticated in the financial markets, and it's now quite a fad to be talking about Bitcoin. A while ago it wasn't. Nobody knew what they were. They've become a highly speculative counter, and it would be difficult to try and trade that thing. But anyways, if some people want to take a portion of their income, or if they sell an asset, take a portion of it that way, that's up to each individual.
Well, according to Sports Illustrated, 78% of NFL players who are retired for only 2 years file for bankruptcy, and after 5 years of retirement, 60% of NBA players are broke.
Oh my gosh, you got some numbers there. So that confirms Andrew's point that they have not been experts. So okay, then that is fascinating. Yeah, actually, it's too bad, really.
And I know the NFL...
these high-paid athletes are not able to get the advice and the discipline they need.
I know the NFL, when they have rookie players, they do have seminars available. Here's what you should do with your money. Mm-hmm. We're not telling you what to do, but here's a good way to do it because, I mean, look at this incredible number. 78% are broke. They start spending, I'm sure, like they were still making... $40 million a year, like some of the quarterbacks. But the thing is, not everybody made $40 million a year. And if you're a running back, especially, you have a very short career because the game is hell on your ankles and knees and hips. So, for anybody in that kind of situation, are they wise to go to those seminars and listen to that?
They indeed are. Now, I remember reading one just recently here, and it's useful for everybody who gets into a good income situation. It was one of the actors from the 40s and 50s, Joel McRae. He played some good comedies, and he was also really liked doing westerns. And when he was first rising and starting to make some money, an older actor had said, look it now, son, you're making a way above the average person's money. Take half, save it. And he had that discipline, and then he also got other advice, and he liked the ranching life, so he and his wife bought a ranch outside of Hollywood somewhere, and he made a lot of money. Now, one of the other well-known personalities of the time, the comedian Bob Hope, he also invested wisely and made a lot of money in land. So
he also was a big holder.
All of us.
Bob Hope was also a big holder in Texaco.
Probably.
Yeah.
But also, what you want to, what the discipline is to, no matter what you're making, save enough to put it aside in a bulletproof place, and then work on that afterwards. And it's very sound advice throughout all of history. Is make more than you spend, and look after what you're saving. So
yeah, never assume the income you have today is going to continue. I've worked in broadcasting my entire adult life, and I can tell you if I hadn't put money aside, I would have starved to death a long time ago.
Yeah.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, one of the headlines that caught your attention today, Rise of the Retail Army, Amateur Traders Transforming Markets. And I saw a study that found that about half of the millennials who received relief checks from the Biden administration plan to put that money to work in the stock market. Is that a good move on their part?
No, but it's a popular move. This is what happens is that at the top of a long bull market, it becomes so well known that they said amateur traders or amateur investors or amateur people get in, and it comes down to the old ironical statement out of New York was that the public is not allowed to make money in the stock market. And the reason that is because the public usually comes in at the top of a lengthy and terrific bull market. So they make the market. So, and once the last, and this is an old saying from way back, once the last person's bought, who is left to buy? So this is where we use our momentum things and the other technical stuff we've got is to measure that enthusiasm. Oh, Jim, I just remembered another old one from the 60s about big speculative markets is that analysts have found it difficult to quantify effervescence. And this is what we are in. It's an effervescent bubble we're in. And it doesn't matter how long it goes on. You want to recognize the condition and realize that it's not a time for new investors to the market to be going aggressively long. You may make money into next week, but then all of a sudden, and of course, one of our technical tools is the springboard buy, and this model was designed to provide the buy on a dip in the market when the market is in an uptrend or a flat trend, but, in pretty sound shape. So that's how we used to buy the dips. But then you come to the philosophical question, when is the last springboard buy in a bull market? Well, you don't know. We got a springboard buy a few weeks ago on the S&P, but you don't know, and then we don't know now, when is the last springboard buy. And you won't know until the market takes out the previous level, at which case where you bought the dip or had the springboard buy. So these markets are always fascinating.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, economist Larry Summers says Biden's stimulus plan will result in runaway inflation. will that $1.9 trillion relief bill result in that?
This is what the street is saying, that, and I think that this is sort of like 1970s, when the inflation really was in commodities, in goods and services, in wages and taxation. And that was, they called it galloping inflation or runaway inflation. And it's pretty nasty, because the problem is that ordinary wages don't keep up with the rate of inflation, so it gets distressful. But then this is where many learned, and actually James Dines was early on it in the 60s, that the Fed reckless policy would lead to inflation. He was right that it would lead to it. But the problem is you have two kinds of inflation. And one is in the 1970s type of inflation in things, and then the other is what's been on for a couple of decades now, which is inflation in financial assets. So you have a tremendous irony whereby in the 1970s, long rates went from 5% to 15%, unprecedented, because of inflation in tangible assets. But here you have now, in the last decade, you had, for example, the yields for the German 10-year note go to minus, nominal. It never happened before. So, but what that is huge inflation in bond prices. So, and then you've also had huge inflation in stock prices, way outperforming commodities. So, and if you go back in history, the pattern has been inflation in things, tangible assets, CPI, commodities, the whole thing, huge boom, and then that ends, and then you go into the era, a new financial era, where the inflation is in financial assets. And then once the inflation in financial assets is over, then it's over. You go into a post-bubble contraction, where the prices of most assets deflate. So this is where it's a fresh imagination based on 1970s thinking that all of this recklessness by the Fed and the new Biden administration is suddenly going to put on the old-fashioned 1970s kind of inflation. But we're going to stay with the pattern in history that's been there for 300 years, is once the inflation in financial assets is over, then it's over. So this is where, when this current bull market finally rolls over, it is going to be very important, because the history suggests that it's going to lead to deflation in most assets.
Well, I remember the late 70s, early 80s, Canadian savings bonds were paying 21% interest, and the whole idea was to A, encourage saving, and B, to cool down that rampant inflation. Could you see interest rates going that high again if hyperinflation happens?
Yeah, Jim, but hyperinflation won't happen because it's been hyperinflation in stocks and bonds. So, but that, yeah, I remember the long bond in Canada traded at 19%. And if you bought the long bond at a 19% yield, you were getting 19% on your money then for a long time. Plus, then there was a huge appreciation in bond prices. So that was the place to be. But no, hyperinflation in the CPI or in goods and services is highly unlikely, because we have had hyperinflation in stocks and bonds, and deflation always follows inflation in stocks and bonds. So we'll stay with that one.
British mortgage company Greenfill has filed for insolvency, and I said Greenfill will be going into the landfill in that case.
Yeah.
And one of the fallouts of this is that the East Indian Steel Company Gupta could end up bankrupt as well, because they're relying on financing from a now bankrupt Greenfill.
Yeah.
Is this the kind of thing we're going to see more often?
I think it could be, because you got to go back to early 1900s when the U.S. Federal Reserve System was formed. At that time, the establishment and everybody knew that if you had a financial crisis, it would be followed by a recession. So then part of the pitch behind forming the Federal Reserve System was that it would be there as an agency to be a lender of last resort. So you had a company that was running out of liquidity. The lenders in New York, banks and whatnot, were unable to bail it out. Then the magic of the Federal Reserve would come in and be the lender of last resort. Now, it is still a very attractive theory because by preventing a credit crisis, you then prevented recessions, and that was the other big part of the story. So, but let's not count this one. This is a strange recession which started in February a year ago. Just wash that one out. But prior to that, there has been 18 recessions since the Fed opened its doors for business in January 1914. So the theory that being a lender of last resort prevents financial crisis, this prevents a recession, isn't working. And the reason for it is that because a company getting in difficulty is not at the height of a boom, is not on its own. Everybody else is in, and then you get the domino effect because this Greensill, sort of a mortgage lender agency company, which I'd never heard of until it started getting headlines a couple of months ago. Then you see, then there's another aggressive company, Gupta, that's depending on that. So this is how it all becomes a domino effect. And this is what defeats the theory of a lender of last resort, is that it's not just one company or one financial agency that gets into trouble at a time. Because you're in a mania, financial mania, everybody gets leverage. So I think, yes, Jim, there'll be more of this. Now, the other one is that you take a lesser country, I mean, Brazil or Turkey or South Africa. Well, that was the headline on March the 1st, that there was a trio of lesser countries. Their central banks were in trouble. So these lesser countries, central banks, they're going to need a lender of last resort from somewhere else. So again, the lender of last resort is a very appealing theory, but it's never ever worked.
Bob, thank you so much for chatting with us.
Yeah, Jim, good to be with you, and looking forward to next week.
Thank you very much, Andrew, Michael, and Kathleen, for your questions. Bob loves to answer them. So if you have a question for Bob, you can send it to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.